Okay, next topic is life cycle costing. Life cycle costing is not alternative of any costing method, but it is alternative of looking at the cost per unit or per year basis. So life cycle costing involves looking at the profitability of a product over its entire life cycle. So life cycle costing helps us in long-termism because we will not be worried about making profit for a particular year or maybe per unit. What we will try and focus is that the profit over the entire life cycle of the product is increased. Life cycle could be 3 years, it could be 5 years, it could be 20 years, depending on how long the product is going to be sold in the market. Those companies that regularly develop products rather than having just one product, like Apple company or Samsung company, they regularly develop mobile phones, for example. So they could use life cycle costing for their products. And the cost that will be included in the price of the product is the life cycle cost. It is not just the production costs, it is the development, the marketing and everything. And that is why usually they cost expensive. They are sold expensive than the material cost because of all these costs involved in them. So there are different stages of life cycle of a product. So understanding those stages will help us understand where we are. If our position is bad because of a stage, we shouldn't worry about it because at different stages we will have different position. Okay, different stages of the life cycle of a product is development stage. Development stage is the first stage. It is where the product is being designed, the tests are undertaken, maybe technical data is purchased from other companies. So this is the profit line, and we are below the profit line. Obviously, at this stage, we will not have any revenue. Everything is spending money. So as you can see, the money increases, the expenditure that we are doing on it increases, our loss increases. But we shouldn't worry about profit at this stage because we know that there are other stages. A very good example where I will compare life cycle costing is to a tree. For example, you have a tree, maybe apple tree or mango tree, whatever it is. So initially, you will not expect it to give you fruit in the first year maybe, but later on, in the later life of the tree, it will start giving you fruit. So we shouldn't worry about. So life cycle costing actually tells us you shouldn't worry about the product not being as profitable in some of the stages. So we need to understand, is it because of the stage or is it because the problem with our business? Okay, so at development stage, we're only doing expenditure, there's no revenue. And then we have introduction stage. At introduction stage, we release the product to the market. We spend a lot of money on advertisement, a lot of customer service. So we are still in the loss stage. So we are not yet in the profit stage. Remember, the introduction stage for different products are different. Some products don't even have introduction stage. As soon as they are released, the demand is peaked. So I'm talking about the usual life cycle of products, the normal, the average products life cycle. So at introduction stage, normally you would not expect any profit because one reason, because we have less units sold and we have a lot of fixed costs. We have spent a lot of money on marketing. because of these factors, we will not expect profit. And then we have, remember, an introduction stage, we will study this in next section in pricing chapter. At introduction stage, the price elasticity of demand is going to be more than one. You will study that in pricing chapter. But more than one means that price is elastic. What it means is that if we change price even by a little bit, if we decrease our price a little bit, demand is going to be increased. Or if we increase our price, demand is going to decrease by a very huge margin. When product is new, slight changes in the price makes a huge change in the demand. And then we have the growth stage. At growth stage, people buying the product increase, and we start making profit. One of the main reasons is economy of scale. Economy of scale means selling something in large quantity. Because of selling in large quantity, the fixed cost when divided becomes less, and maybe we have the power to buy at lower price from our supplier. At growth stage, we usually open other branches. We receive feedback from our customers. Our other competitors are coming to the market. They're realizing that there's a product that has huge profit in it. So we have other people coming as well in the market. And at growth stage as well, the price elasticity of demand is going to be more than one, which means if we change our price slightly, our demand will change huge. And then we have the maturity stage. A maturity stage is the highest level that the product reaches. This is the maximum profit that we are able to make. This is the highest economy of scale point. And we usually don't spend a lot of money on marketing, because the people that wanted to buy the product, they're all buying the product, so marketing will not affect as much. If there is going to, remember, the effect of marketing is going to be huge in the introduction and growth stage. At maturity stage, the benefit is not expected to be as much. Sometimes even maybe the cost is going to be more than the benefit that it gives us. At maturity stage, because of the highest economy of scale and lower costs of marketing and stuff, we have the highest profit. And at maturity stage, the price elasticity of demand is going to be less than one, which means that we have to change our price by a high margin in order to increase demand. To decrease price, remember, demand increases. If you increase price, demand decreases. And then you have decline stage. When the product, the customers slowly stop buying the product. So there is a decline in the trend. We say there's a decline in the trend in the market for this particular product. What some companies do at this stage is to boost the demand temporarily. They might change the product a little bit, maybe changing the packaging or maybe changing the flavor a little bit. But all of those things is going to increase the demand only temporarily. There's going to be a slight jump in the demand. It's not going to be something permanent. So what it means is that if we know that we are in the decline stage, we shouldn't do any long-term effort for the product, because no matter how much effort we make, it is not going to have a long-term survival. And then finally, we have withdrawal. Obviously, this stage is not explained in the book, but this is also something you need to know. This is when eventually we take the product, we withdraw from the market, which means we don't sell the product anymore. There will be still some customers, but the cost of providing the product to those customers is going to be huge, and we will not be able to make profit at that stage. So we stop the market. So if we are selling a product and we are not making profit because it is in introduction stage, we shouldn't worry about it. But if we are selling a product and it is in decline stage, then we should worry about it and maybe close the product. So life cycle costing tells us, don't think about the profit here, don't think about the profit here or decline stage. Look at the profit or the entire life. And whenever you are releasing the product, see whether the cost that you're going to spend and the revenue that you're going to receive, whether revenue is going to be more than the cost that you're incurring. Remember, at decline stage as well, the price elasticity of demand is going to be less than 1. Okay, so what are the costs that are incurred in the entire life cycle of the product? And remember, whenever we are costing our product, we include all of these costs into our product. And as I explained, that is why the products of some of the companies are so expensive. Even when you're looking at the material costs, they are not as much. So the cost that will be incurred in life cycle of a product is research and development, like design cost, making prototype, testing cost, purchasing any technical data, as I explained, training staff into new technology, new product, production cost, distributing it to our customers, marketing and advertisement, and inventory holding. Sometimes what company would do is they would make inventory for the entire life of the product and then keep it there and then sell it over the entire life. And then retirement and disposal simply means when the project finishes, the cost relating cost of cleaning the environment or the place will be included in it. Okay, what are the benefits of life cycle costing? Why should we look at the entire life of the product rather than per unit or per year? One thing is, it helps management to assess the profitability over the life cycle, so they will take earlier action. So they will decide whether we should release the product into the market or not. So instead of releasing and then later deciding that it is not as much profitable, we have spent too much costs on it, so it would not be a good decision. So it gives us that earlier action. It is useful for those organizations that I explained previously that regularly develop the product. And usually it is said that about the companies that regularly develop the products, they can predict the cost of the product up to 70% accuracy. And the earlier action is the same as above. And remember, it is a better decision. Why is it better decision? Because it is a decision not just about a unit or year. It is a decision that looks at the entire life. You could think of it like a project. Like some projects, when you're taking in initial stages of the project, you will be spending money, but in later stages you will be earning money. So we shouldn't look at the profitability of a project just on a particular year. Just like that, we will look at the profitability of a product over an entire life cycle. And remember, as I said, it helps in long-termism, looking forward. Customers also have life cycle. One way that you can increase the life cycle, the return over the life cycle, is to increase the life cycle of the product. Another thing is to increase the life cycle of your customer, maybe giving them discounts, maybe giving them loyalty cards. So the longer a customer comes to you, the more profit you will be making from it. So it is better to have a regular customers than customer that only come once. So how can you increase return over life cycle? One thing you could do is reduce break-even time. Break even, remember, means the point where you make no profit, no loss. So it simply means try to make profit as earlier in the life cycle of a product as possible. One reason is the sooner you receive your money, the less the risk involved. Another thing is quickly release product into the market. Don't wait. Maybe a competitor realizes that you are making a certain product and they make exact same product, and before you release it into the market, they release it into the market, so you will not be able to make profit on it. Increase life cycle. Remember, one way to increase is to make a little bit changes to your product. Okay, let's look at a question on it. Required, calculate cost per unit, looking at the whole life cycle, and comment on the suggested price. I have another requirement here as well. We will look at that later. But Solaris specializes in manufacturing of solar panel. It is planning to introduce a new slimline solar panels, specially designed for smaller houses. Development of the new panel is to begin shortly, and Solaris is in the process of determining the price of the panel. It expects the new product to have the following costs. We have units manufactured and sold, 2,000, 15,000, 20,000, and 5,000. Remember, it has a 4-year life. And you can see in the first year, the units are not as much. In second year, it increases. In third year, they are the highest. And in fourth year, they decrease. And then it doesn't go to the fifth year because obviously it will be so much less. And then we have research and development cost, 1.9 million. It is higher in the first year, and then it reduces in the second year, and nothing in the third and fourth year. We have marketing, higher in the first year, a little bit lower in the second year, and it decreases, and eventually even only 10,000 in the fourth year. And then we have product cost per unit. It is 500 in the first year. It becomes 450 in the second year and 400 in third year. See, because of economy of scale, when you're producing something in large quantity, usually the cost per unit reduces. We have customer service cost, 50 and 40, 40 and 40. Remember, these are costs per unit, and these are total costs. And then we have disposal of special equipment. This is not a cost, this is revenue. We are receiving something, so it is disposal of equipment. The marketing director believes that customer will be prepared to pay 500 for solar panel, but the financial director believes that this will not cover all of the cost throughout the life cycle. So let's calculate the life cycle. So marketing director believes that we need to charge 500. So let's see whether we will be able to cover 500 or not. So we have 4-year life. I've already added the quantities. Let's write the research and development cost, which is 1.9 million. This other one, 100,000. And then marketing in the first year is 100,000. In the second year, 75,000. And then 50,000 and 10,000. And then disposal of equipment. In the fourth year, I'll write it as a minus. Okay, production and customer service. What I will do is I will add them together. Instead of multiplying each of them separately, what I will do is I will add them together. Just production and customer service. Okay, we have 500 plus 50. So add all the per unit costs and then multiply by units. That will be a quicker way of doing it in exam. And then we have 450 and 40. Remember, I'm multiplying by units because they're per unit cost. We have 440. And then in final stage, we have 450 and 40. Multiplying by units. So we have per year data. Now we can add all of them. Adding it together, we have total cost. And then dividing it by total number of units over entire life, we have 515 life cycle cost. So life cycle cost is 515, and the target price that the marketing director said is 500. If we follow that, we have 15 extra cost. So if we develop the product, we will not make profit, no question of profit. We will be spending $5 extra per unit, which means if we multiply by total units over entire life, we will be making about $30,000 loss over the entire life of the product. So if we could reduce the cost maybe and then make it a little bit lower than the 500 target price, then maybe we will go ahead with the development. Otherwise, we will stop developing the product. So this is the benefit of life cycle costing. It gives you that earlier action. I added another requirement here. It is the company's policy to make 10% margin on all products. So find target cost and target cost gap. Remember, our target price was 500 and the target profit is 10%. That will give us target cost of 450. And our estimated cost is 515. So we have a target cost gap of $65. Remember, sometimes life cycle costing and target costing can be merged into one topic. So if we are able to reduce the cost by $65, then maybe we will go ahead with the product. Otherwise, we have to sacrifice profit a little bit, maybe decreasing it by a little bit margin. If that is our margin, that is acceptable, and no change is expected in that. So this is not a profitable product, so we will stop making it. So this is life cycle costing done.